Hello, everybody, and welcome once again to Public. I am your host, Kinsey Grant, and would you believe it or not, Netflix has raised prices again. So what might the company's recent earnings tell us about what's behind that rate hike, if anything at all? Here to break down the streamer of all streamers Q3 is Mark Mahaney, head of internet research at Evercore ISI. Mark, welcome to Public. How are you today?
Good to see you, Kinsey.
You as well. You as well. It's been we're in the thick of earnings season. It's been an interesting week. We had Netflix earnings for Q3 recently out. They added nearly 9 million subscribers last quarter, biggest quarterly gain in the past 3 years, well above Wall Street's expectations. Mark, tell me a little bit about what was behind all of this momentum in Q3. What would you say is one of the key drivers of this subscribers beat here?
Well, Kinsey, you're right to focus right on the subscriber growth. I think that's always what moves Netflix more than anything else. It's, there's occasionally debate about the revenue they get per user, ARPU, or their operating margins or their free cash flow generation. But it's really the movement, and what investors focus on for good reasons is the subscriber number. So they came in well ahead. People were expecting something like 6 million, and they did 9 million. So that's, I think, 50% more than expected. That's unusual. And they also guided aggressively. At least the street was looking for something like 7 million in subs, paid subs, net ads next quarter. And they guided to, they give this qualitative guidance. It'll be similar to what we did in the September quarter. So I guess that's 9 million again. So how the heck is this happening? We think there's three things that are going on. First is they are rolling out this paid sharing. You may have been cut off, or you may have had people who were borrowing your account, Kinsey, cut off. But they've been doing this, globally. They had said about a year ago that there were about 100 million people, 100 million borrowing households. And I may know a few on my account. People, there may be some relatives of mine at college, that may be using my account. There may be an au pair, that may be out there using my account. And so this has been a source of new subscribers for Netflix. Secondly is they've been building out this ad-supported offering for $6.99, and that equivalent price in local currencies, in about a dozen international markets. That's probably created more subscribers. Why? Because people are price sensitive. And, you've seen rising price sensitivity, or we have in our survey work since 2018. So that's probably unlocked a few more sub ads. And the third one is the content slate. Now, I don't know whether that suits in North America, and it's funny, but, Netflix has this ability to really take old shows even and new shows and just blow them up into the zeitgeist. So who knew that Suits could be the most popular show on Netflix for like 13 weeks running, across streaming as a whole for 13 weeks running. So Netflix has that power. But in the international markets, and they had record number of net ads in Europe. There were a couple of local language originals, what we call LLOs, in Germany, France, Italy, Spain, and I think one other market over there. And apparently they did really well. So it was kind of this triple storm, but in a positive way. Paid sharing, ad-supported lower price plan, and just really good content that drove these subs.
Yeah, absolutely. And that kind of three-pronged approach to this last quarter for Netflix is one that I want to dig into a little bit more, especially as we consider what might be in Netflix's future. Knowing that you have an outperform rating, a $500 price target on Netflix, the expectation, I'm assuming, is that, this isn't going to go away, right? We're not going to totally reverse course. Things aren't going to go kaput for Netflix in the immediate future. But those three things that you mentioned, I'm curious about the longevity for all three of those elements. When you consider the addition of paid sharing and this ad-supported offering for Netflix, this ad-supported tier, and even the content as well with the writer's strike, I wonder how much of the momentum that there is to be grabbed for Netflix has already happened. So can these things continue to drive growth for Netflix when it comes to subscribers? Or do you think that the bulk of what they were going to get has already been gotten, for lack of a better way to put it?
No, you're asking the right question. I mean, it's impossible to really know with certainty the answer, but we got to work through some logic points here. So I think about those three drivers. Yeah, paid sharing is that as a driver of new subs. It's going to become smaller and smaller. And it probably lasts for another 1, 2, 3 quarters, something like that. But it'll become smaller contributor. I think the ad-supported offering, this $6.99 cheap Netflix version, I think that as a driver is likely to get bigger and bigger because I think awareness of that still is a long way to go. Not so much in the U.S., where they already have 70 million, paying households. And one of the reasons people like Netflix is that they don't have ads. So I just don't think the ad-supported offering brings in a lot of new subs in the U.S., but maybe a few million. I think it really helps out more in other markets where they're less penetrated and where like the full price Netflix offering may be a little bit cost prohibitive. So I think that is one of those three factors is going to rise. And then the content stuff is, hit or miss. The advantage you have that Netflix has is that the expression I use is they have so many shots on goal. I mean, they're spending 17 billion in cash next year. That's what they spent last year. They couldn't do it this year because of the strikes, but that's the kind of chunk of change that they put out there. So you do that, and every once in a while you come up with Stranger Things. Every once in a while you come up with Bird Box. Every once in a while you come up with Squid Games, and then they can also now, one thing that Netflix can do now that they couldn't do before is that they can start licensing content because now competitive environment is lessened and those other studios that didn't want to license to Netflix are now licensing to Netflix. That's why Suits, I think, is on Netflix. That's why Band of Brothers is on Netflix. And Netflix has the ability to take these shows, and even though Band of Brothers was, I forget, 20 years ago, like it's now one of the more popular shows on Netflix. Netflix has that power. So anyway, I just think that as a driver, the quality of the content, I think that's the same. So how all those three mix out, one's less, one's more, less paid sharing, more ad supported content is kind of, it's going to be pretty consistent. So I think you still get this kind of 10 to 20 million new subs that I know it's a huge range that Netflix can add, next year and the next couple of years.
Yeah, it's very, very interesting to, especially with that content piece. That's a way that I had not really thought about it up till now. This idea that Netflix almost adopts this venture approach to
Right.
content. Spend a lot of money to know that 90% of these are not going to be smash hits, but for those that are smash hits, it becomes a real centerpiece of culture and of zeitgeist. And you get the Stranger Things, and you have people who are waiting with bated breath for the next season. That's a really interesting way to understand the process and the strategy for Netflix. But with all of this in mind, especially with the content focus, knowing that they might be spending a little bit less because of the writer's strike, which has ended, but the actor's strike, which continues after conversations and negotiations kind of fell apart recently. I'm curious about what the effect might be on Netflix, knowing that content and really premium content that's really good and really can captivate people is a big cornerstone of Netflix's growth strategy. How is the strike, the dual strikes, and one ending, one continuing, how might those impact Netflix in the long run?
Oh, I don't know that they impact Netflix in the long run. Although it's possible that the resolution of the strikes just simply requires Netflix to carry a heavier cost structure or a bigger cost structure going forwards. Maybe that's what you were getting at.
Mm-hmm.
And that, in fact, that makes sense to me. In the near term, like in the next 6 to 12 months, it does have an impact. They haven't been able to. It's not like COVID when you literally had production facilities shut down for 3 to 6 to maybe even 9 months, and that created kind of these holes in the content offering. Um, uh, well, it's kind of like that actually. So that's the risk that they just don't have as strong of a content slate that they can offer, or that maybe most of the production was locked and loaded before the strike went on. I think that's true. So Netflix has a bit of an advantage over other studios that way. But there is going to be this hole in the content slate, next year, and so that is going to cause a challenge to subs growth next year. So that's the impact, Nancy. I think you're right to point that out. That's one of the risks you have to deal with Netflix here.
And knowing that, the final verbiage of any of these agreements that might be reached to end what are continued strikes is yet to be seen and yet to be totally understood. But obviously, getting royalties from streamers has been a big part of the fight for those who were striking. Is this material at all to Netflix when it comes to considering a future in which a studio like Netflix or a streamer like Netflix, kind of however you want to define it, it might have to add that to its structure? Is that something that is worth considering, or is it going to be marginal?
My guess, Kinsey, is that it's going to be marginal.
Okay.
And if Netflix didn't have any pricing power, it's possible it could be material. But Netflix has pricing power. I guess they just pulled it last night. They're taking their premium price plans up from $19.99 to $22.99, if I remember correctly. And I think they have that because it's an extremely good value proposition. Still even at that price point. So I think that's the reason why it's not a material negative for Netflix in the future, because
Mm-hmm.
they have pricing power.
Yeah, it makes sense. And I think that, it's a good segue to talk about consumers' approach to understanding how we pay for Netflix and what the value of Netflix as a subscription service is. It almost seems like it's price inelastic. I have had Netflix. I carry the burden of the family for paying for Netflix. And, I've never canceled my account because of a price hike, candidly, just in my personal experience. And I imagine that is kind of the norm for a lot of people as well. Tell me a little bit about what the price hike impact is, both for Netflix as a business, but also just for consumers who might consider subscribing to Netflix or might consider canceling a subscription to Netflix.
Well, I want to be clear. There is, we're all at some level price sensitive, and Netflix customers, current, past, and future potential, have shown, and based on our survey work, rising price sensitivity since about 2018. So we had seen that. Why would that have happened? Because the company kept raising the prices of its service. So yeah, there is elasticity associated with any price increase. The question is just the magnitude of the elasticity.
Mm-hmm.
And then, but there's something new in town with Netflix, which is they're now, I think they call it widening their price points. I call it accordioning their price points. So they're taking their upper price points and raising them up. But what they also did is they took the lower price points and brought that down. That's the $6.99 offering. And by the way, that's the cheapest high quality uh, entertainment package you can get out there. $6.99. I mean, I think you and I could walk down the street and get a latte and spend more on, especially in a city like San Francisco, you could spend more than that on a, whatever, on a drink. So it's darn cheap. And I think that, and there are, there's reasons why some people are going to pay that $22.99, probably me, because I do get, a bunch of different accounts in the house that use it, get different download capabilities, Ultra HD, etc. And it is just an enormous, amount of content. And what are my options here? I'm going to go into the theater and spend that much, without even buying the popcorn, and that's one night. And the quality of the content at Netflix, based on their years and years of survey, is still considered to be the best out there in streaming land. So hats off to Netflix for that. So I'm sure it'll lead to some churn, but what's different this time? What is different this time is that every time that Netflix ran price increases historically, um, there was no out. There was no like, well, I'll just go to the really cheap plan, because they always not always, but they usually raise the price of the low price plan. It's different this time. Famous last words. But that's because they're doing this now with the $6.99 plan. So look, if you really are unhappy with the basic plan going up, standard plan, by the way, is the same, but with the basic plan going up from $9.99 to $11.99, yeah, you have an option here. You can trade down, take on some ads. A lot of people are fine with that. If they're price sensitive, they'll be willing to take on ads. And so, yeah, that's the hedge now that Netflix has that they didn't have before.
Yeah, very interesting. And you mentioned that Netflix continues to really have the most premium offerings, whether we're talking about new content or just great shows that people love to, quote unquote, binge watch. There has been an increase in competition. There was a period of time when all of Hollywood was talking about their Apple TV Plus show or movie or insert series here. Tell me a little bit about the competition and the competitive landscape before I let you go today.
I think it's peaked.
Okay.
So famous last words, I may well be wrong in that. But when the CEO of Disney gets fired for running excess losses at the streaming business, that's peak competition. And what's happened across the industry? All the streamers have been kind of, like every other company in America, have been under pressure to show some profits. Profitless streaming growth is not smiled upon by investors. It was for 2 or 3 years. It's not the case now. And so these companies are doing what you would expect to do when you're under pricing, when you're under cost pressure. They've raised prices and then they've cut back a little bit on their content spend. They've cut back a little bit on their marketing spend, and they've done something different. Instead of saying we're not going to license our content to that bad competitor Netflix, now they're willing to license content to Netflix because they need the cash. And so that's a fundamentally different situation. Like, you want to be careful about the leader of the pack when competition is closing in. You want to be positive on the leader of the pack when competition is kind of winnowing out. And I'm sure these are cycles. I'm really struck by you had in 2019, 2020, 21, and even in 22 a little bit, rising competitive intensity. That's a dramatically different. We have a dramatically different environment now than we had back then.
All right. Well, Mark, this has been wonderful. I really appreciate all of this great insight. I learned a ton, and I think it's, Netflix is always an interesting one to talk about. Unpacked some new stuff today. So thank you so much.
Thank you, Kinsey.
Thank you again to our guest, Mark Mahaney, Head of Internet Research at Evercore ISI. And thank you to all of you for listening. I'm Kinsey Grant, and I'll see you next time.